Okay, let's continue on with analyzing common stocks. And we're going to now move to the third category, which is the fundamental analysis of a company. So now we want to look at the financial statements. We want to try to, the phraseology in the industry is we want to see the story of the company. What does the company tell us about the company? Right? So we want to look at the financial affairs inside the company itself. So we want to look at financial statements. From that, we're going to be able to develop things like understanding the competitive position of the company. What kind of assets does it have? What's profitability like? Composition of assets. What's the financing mix look like? How does the company gather funds? This is pretty time consuming and is a very demanding phase. So again, we need to rely mostly on published reports because doing this type of activity ourselves, most people just don't have the time to do that. We need to understand the statement. So let's talk a little bit about financial statements. There's something called a balance sheet. A balance sheet basically describes what a company owns and what it owes. So the assets of the company is what it owns. Some of those things are real, you can touch them, and some of them are not. Some of them are intangible. Liabilities is what we owe. So if you take away, or if you subtract what we owe people from all the assets that we own, you're left with what's referred to as stockholders' equity, right? This is the claim that the stockholders of the company have on the firm itself, right? So total assets has to be equal to what we owe, the liabilities, plus what we own, the equity. So what things do we look for in balance sheets? We look for the relative amounts. Is the company growing or shrinking? We look for trends. Is the company improving or is it not improving? Is it decreasing? So let's look here at a financial statement real quick, right? Here are the assets of this company, right? This Universal Office Furnishings. Total assets. In 2015, 761. In 2016, it's 941, right? So the company asset-wise is growing, right? Well, how did it grow? Well, it grew by what? That's almost 200. It went from 552 to 646. So that must mean that that number went up roughly about 100, give or take. So we got $100 more from creditors. So if the company grew by 200 and we went up by 100 with the liabilities, where did the rest of the money come from? Well, it went from 209 to 294, again, almost 100, from shareholders. So the assets are equal to the liabilities, what we owe people, and what we actually ultimately own and what shareholders have invested. What does the income statement show us? Basically, it's a performance measure, right? The company has produced a certain amount of revenues, right? We've sold some things or we've performed services. What did it cost us to perform those? Those are the expenses of the company. The difference between revenues and expenses is profit and loss. Again, what are we looking for? Relative amounts. We're looking for trends. But in addition here, we're looking for relationships, right? What is the relationship between certain expenses and revenues, right? What's certain line items, certain things that we can identify? How do they relate to the company's business? Are those things growing faster or slower, right? Is there a relationship that we can identify that tells us the company is doing better or worse? So here's our income statement. And again, you can see from 2000 to 2016, right? We've increased by, give or take, a little bit over 70, these are $70 million more from running the company. Our total earnings before interest and taxes have actually gone down $2,000. So we've actually lost some money in operations. After taxes, earnings have gone down from 141 to 139. Again, is that necessarily good or bad? Obviously, less profits is not necessarily a good thing, but we need to identify what's going on in the company that's causing these changes. One other question that can help us answer that, or one other statement that can help us answer that, is something called the statement of cash flows. The statement of cash flows combines the decisions that companies make. Right? There are three basic decisions that a company makes. And I'm just going to go to the next slide, which has that has the statement, so that we can discuss what's going on. Right? One of the things we need to know is how much cash does a company generate from operating activities, from doing the business. In this case, you can see that we're down about $10 million. We've generated $10 million less in cash this year than we did last year from our office furnishings business. What else happened? Well, we also bought some assets. Last year, we spent $90 million on buying assets. This year, we bought $97 million. So we actually have expanded our asset base, which, again, we talked about a little bit earlier. Assets increased. So it increased by $7 million. What other kinds of decisions do we make? Well, the only other basic decision we make is how do we pay for things? How are we covering the financing activities of the company? And in this case, you can see the what? Last year, we spent $150 million in financing, right? In this case, you look at, we actually paid off some debt, right? This year, we only spent $82 million in financing activities. That doesn't mean no money came in, but in this case, this year, there was like no change in borrowing, right? We paid dividends. We've actually bought back some stock, right? So we have some activity going on here. So the net change, the net increase or decrease in cash, we saw a $15 million decrease in cash over this last year. So the questions are, how do we fix that? Do we want to mess with the investing activities? No, it depends. That's a strategic plan. What if we're planning on expanding? We're going to have to buy assets, right? Maybe we want to look at how we gather funds. We need to gather more money rather than having more cash outflows. Figure out a way to get some money to come in so that we can buy these assets that we want. And finally, we always want to make sure that we have an increase in cash flows from operations. We need to do a better job here. So let's look and see what those problems are. And that's what financial analysis ultimately is all about. Financial analysis is about looking at these statements and trying to figure out where the company is doing well, and we want to continue that. We don't want to mess with things we're doing well. But we also want to identify those things that we're doing poorly on so that we can take measures to hopefully fix those things. That is what ratio analysis is all about. We want to look at the numbers. We want to make comparisons to different items in the financial statements so that we can come to a conclusion as to whether the company is doing better or worse. So we want to look at the company's ratios and compare them to history. We also want to compare this to other companies, maybe to the industry. So if we get an understanding maybe about what's going on in the past, that can give us some degree of confidence of where we think the company is going to go in the future. So the first set of ratios we want to talk about are called liquidity ratios. Does the company have enough money to pay its short-term bills? Well, the current ratio is just current assets divided by current liabilities, right? It's one of the best measures, I say here, of a company's financial health. The higher the number, the more liquidity we want. And I think a good way to think about this is current assets is an equivalent to cash. Current liabilities are equivalent to the bills we have to pay. So if we take the cash divided by bills, we better have more, this better be greater than 1 so that we can show that we have more money than what we need so that we can pay our bills. Again, liquidity is an ability to pay number. The quick ratio is the next ratio. It looks, again, it's a liquidity ratio. It's a little bit more conservative because we're going to subtract inventory. Inventory is a little harder to get rid of than some of the other current assets. And again, in this case, you can see that even if we take out inventory, this company still has enough cash to pay its current obligations. So it's showing some decent liquidity. Now, of course, we want to compare this to history, not just the company's history, but also to the industry. Net working capital. Now, this really isn't a ratio, and it's not a relative number, it's an absolute number. So it's kind of difficult to make some real direct comparisons to. But essentially, we're saying, look, how much cash do you have? Subtract out the bills. This number better be positive, right? So we want companies that have enough liquidity that we as investors don't have to worry about them not being able to pay some short-term bills, right? We want them to have liquidity. We want to have them the ability to buy and sell things. The next set of ratios are referred to as activity ratios. How efficient is the company? How easily can they use the assets of the company to generate sales and profits, right? An increasing ratio means the company is doing a good job in managing its assets. So what about accounts receivable? A very important number. We're going to have to offer credit to our clients, our customers, all right? So how well do we do that? How do we manage that? Quite frankly, I think this number is a little difficult to explain, but if you divide this number by 365, right, we get a number that's called days sales outstanding. And that's a number that you frequently see printed more often. And what this means is, how long does it take the average customer to pay us the money that they want? We want this number to be lower. 30 days is traditional. The closer we can get, the better we want to be, right? Inventory turnover ratio. Again, another kind of a difficult number. We're obviously talking about how well we manage inventory. I personally like a number called DCI. DCI is the days we carry inventory. On average, how long is inventory on the shelf? And of course, you don't want inventory to be on the shelf very long. You want to be able to sell it and get it out the door. We want that, once we've sold it, we want the days sales outstanding to be as small as possible so we ultimately can get paid for the sale of the asset that we have. There's a total asset turnover ratio. How efficiently are we using the total assets that we've purchased? Now, who decides which assets to buy? Obviously, management does. Have they bought enough assets to run the company profitably and efficiently? Or have they bought too much? So a high turnover ratio reflects that what? That we have given our resource base, we're creating a lot of sales. Now, if that number gets too big, we could run into problems, but in general, a bigger number is better than a smaller number, right? We want to be able to generate sales given the assets that we as managers have decided we want to purchase. So that's the end of the fundamental analysis for efficiency ratios. The next thing we'll talk about is we're going to go to part 3 and we'll talk about some more ratios.